One of the most valuable skills you can learn in real estate is how to calculate whether a property is a good one. Those numbers will make or break your investment. This video is going to show you how to calculate the important numbers and make sure you're being smart with your time and your money. So you found a property that interests you, but how do you know if it's a good investment? Let's go through an example to see how to calculate the numbers, or as investors say, let's run the numbers. We go to our spreadsheet and begin putting in the address of our fictional property, 123 Main Street. It's listed for $400,000. The first thing we need to know is the rental income we can expect for the property. We'll talk about how you find that number in a minute, but for now, let's assume that after some research, you've discovered this property can rent for $2,800. And because it is income, it'll be in green, and money going out of your pocket in this example, or expenses, will be in red. Next, we need to figure out the mortgage payment. Let's take out our notepad. When you're buying an investment property, you're going to need 20% as a down payment. That leaves 80% of the price left, and that amount needs to be borrowed from a bank or another lender. 80% times our example purchase price of $400,000 leaves us a mortgage of $320,000. Let's assume a 3% interest rate with a 30-year amortization, and this leaves us with a monthly mortgage payment of $1,345.93. You can find a ton of mortgage calculators online to find this number, so don't worry about the specific math for now. For property tax, which you can usually find on the MLS listing, let's estimate $230 for this home. And for insurance, let's put down $40. Now we get into the rainy day savings. You must, and I repeat must, allocate some of the monthly rent towards things going wrong. It's not a matter of if, it's a matter of when. Repairs and maintenance need to be saved for, and a safe number to put away for this is 5% of the total rental income. You'll need this money when a tenant breaks a light, damages a wall, or just to repaint the place when you're trying to find new tenants. 5% of $2,800 rental income is $140. You also need to put away about 5% for what is known as capital expenditures, or CapEx for short. These are big ticket items like a new roof, HVAC system, new furnace, etc. And they all have an expiry date that will come if you own the property for long enough. Planning ahead and having the money to cover those costs are a necessary part of being a successful investor. Similarly, you'll have tenants leave and you may have a month or two without anyone paying you rent. Saving for this inevitability is a needed line item when running your numbers. 5% for this is sufficient. Next, you might be renting the hot water heater, which we'll say is roughly $40 a month. If the tenant is not paying for utilities, then it's up to you to budget for them. Usually there's water, gas, and hydro. For this property, let's say the water bill per month is $80, the gas bill is $100, and the hydro bill is $120. Now we come to the line item that is known to be a big point of debate in many investor communities. Should you budget for a property manager, even if you plan on managing the rental yourself? The answer is yes. I'll break down the reasons for this in depth in a future video, but for now, just know it is smart to budget for a property manager. Life can change quickly and you never know when you'll need to give up your role and let a professional handle it. So how much do they charge? Many property managers will take 8 to 12% of the monthly rent. Let's split that down the middle for this property and go with 10%. Any other expenses you might have, such as condo fees, parking fees, snow removal, or landscaping. For this example, let's assume we don't have any of those expenses. And finally, you'll need to have a spot in your spreadsheet if you plan to borrow your down payment. You can often use the equity in your primary residence to have access to a home equity line of credit, or HELOC for short. The payment of this money is usually an interest-only payment. The rate of interest can and does fluctuate, so be sure to be accurate when calculating this number and speak to your bank about the details. For our purposes here, and to keep things as simple as possible, we're going to assume you have the down payment in cash and leave this blank. So now we come to the big moment. Does this property produce enough income to cover all of its expenses, which is known as cash flow? You take the rental income of $2,800 and deduct all the expenses from it. Basically, subtract all the red numbers from the green one. After doing that, you see that the property does cash flow, and you can expect $144.07 each month to go into your pocket. That's not bad considering you've accounted for things going wrong, things breaking, and someone else managing your headaches. If you run the numbers and it doesn't cash flow, you move on to the next property and don't look back. So how do we go about finding the specific numbers associated with a property? There's a few ways to do this. The first place to look is the MLS listing of your property. You can often find the property taxes and sometimes even the rental income currently being paid on the MLS listing. If you're trying to figure out how much your place would rent out for, ask a local realtor for comparable properties and the rents they are getting. A local realtor who is used to working with investors would know these numbers and be able to provide feedback about the rents as well as whether the area is a good place to find quality renters. You can also ask local property managers about typical rents and other issues. It is part of their job to keep up on rental trends and provide their expertise.